Gold and silver markets faced a rough trading session this week, and the numbers told a clear story. Gold dropped by more than 2% in a single day, while silver fell even harder. For anyone watching the precious metals space, this was not a small dip. It was a sharp, noticeable slide that caught the attention of traders and everyday investors alike. So what caused this sudden drop? According to market analysts, several forces came together at once. Tensions in the Middle East escalated, and this immediately rattled global markets. When geopolitical conflict rises, investors often expect uncertainty in energy supplies, and that expectation pushed oil prices higher. As oil climbed, something predictable happened next. Rising oil prices tend to push inflation expectations upward, since energy costs affect nearly everything, from transportation to manufacturing. And when inflation expectations rise, interest rates usually follow, moving higher along with them. This chain reaction created a difficult environment for gold and silver. Higher interest rates and a stronger US dollar typically put pressure on precious metals, since gold and silver do not pay any yield or interest themselves. When bonds and cash start offering better returns, some investors shift their money away from metals, and that shift showed up clearly in this week's price action. Chief market strategists who track these movements closely explain that this was not entirely unexpected. They had been watching gold and silver for weeks, noting warning signs even before this latest drop. Analysts pointed out that although the metals had approached a major low point earlier, they still had not shown the kind of strength needed to confirm the bottom was truly in. In simple terms, the bounce back in prices had been weak. Gold had tried to recover before, but each time it failed to climb back up to key resistance levels. This kind of pattern, according to experienced traders, often signals continued weakness rather than a strong turnaround. The initial impact of this sell-off was felt across the entire precious metals complex, not just gold and silver. Platinum and palladium also came under pressure, though to a lesser degree. Even copper, a metal closely tied to industrial demand and economic growth, showed signs of rolling over after facing rejection at a key price ceiling. Many analysts and media outlets had been extremely bullish on copper just weeks earlier, expecting a major breakout. Instead, prices reversed, reinforcing the idea that broader market sentiment had shifted toward caution. For everyday investors, this kind of volatility can feel unsettling. Watching an investment lose value quickly often raises questions. Is this the beginning of a longer decline, or is this simply part of a normal, healthy correction within a much bigger picture? Market strategists who study long-term price cycles suggest the answer lies somewhere in historical patterns, not just short-term headlines. This is where the story becomes more interesting. Rather than reacting purely to daily news, seasoned analysts look back decades, studying how gold and silver behaved during past economic cycles. They compare current price action to previous major peaks and drawdowns, searching for repeating patterns. This approach does not promise certainty, but it offers a framework for understanding where prices might be headed next, even during periods of fear and uncertainty. At Gold and Crest Finance, the goal is always to look beyond the noise of a single trading day and help viewers understand the bigger forces shaping these markets. This latest sell-off in gold and silver is not just about one bad day. It connects to a much larger conversation about debt, currency stability, global tensions, and long-term investment cycles. To understand where gold and silver may be heading, analysts say it helps to look at the technical patterns forming on the charts right now. One of the most important patterns currently being watched in gold is called a wedge pattern. This is a classic chart formation that traders have relied on for decades to predict major price moves. A wedge pattern forms when price action gets squeezed between two converging trend lines. One line slopes downward, connecting a series of lower highs. The other line slopes upward, connecting a series of higher lows. As these two lines move closer together, the space where price can move keeps shrinking. Analysts often compare this to a spring being compressed or pressure building inside a container. The tighter the pattern gets, the bigger the eventual move tends to be, whether that move ends up being a breakout to the upside or a breakdown to the downside. Right now, gold sits inside exactly this kind of pattern. Prices have bounced off support near the $4,000 level more than once in recent weeks. However, each bounce has been weaker than the last. Instead of climbing back up toward resistance, gold has struggled to gain real strength, stalling out earlier each time. According to market strategists, this kind of weakening bounce is often a signal that sellers still have more control than buyers, at least for now. There's also a specific short-term level analysts are watching closely. A descending trend line sits just below the $4,000 mark, and if gold breaks beneath it, many expect a further decline toward the next major support zone. This next level lines up closely with a broader historical pattern that strategists have been studying for months. That historical pattern goes back more than 4 decades. During the bear market of the 1980s, gold fell by roughly 66% from its peak before finally bottoming out. Inflation at that time was extremely high, and that played a major role in how sharp the decline became. Fast forward to the more recent cycle that peaked in 2011, and the drawdown was smaller, closer to 46%. Analysts explain this difference by pointing to changes in government debt levels and monetary policy. As central banks introduced more monetary support and governments carried higher debt loads over time, each subsequent drawdown in gold became somewhat shallower than the one before it. Using this pattern, some strategists believe the current cycle could see a drawdown of around 30% from its recent high. If that estimate proves accurate, it would place a potential low for gold near the $3,500 level. Analysts describe this as a possible bear market low for the current cycle, though they are careful to note that markets can always overshoot expectations in either direction, especially when fear or panic takes hold of investor sentiment. Silver, meanwhile, is showing its own version of this story through a different pattern known as a bear flag. This forms when price breaks below a key support level, then bounces back briefly before getting rejected and continuing lower. Analysts tracking silver have identified specific price zones to watch, with initial support near the $54 range, and a deeper potential floor closer to $46 if selling pressure continues. These are not simple guesses. Analysts stress that these projected levels come from studying repeatable patterns across multiple decades of market history, combined with current price behavior. Still, they remind viewers that historical patterns are tools for probability, not guarantees. Fear-driven selling can sometimes push prices below even the most carefully calculated technical targets. At Crest Finance, understanding these patterns is not about predicting the future with certainty. It is about giving viewers a clearer framework for making sense of market movements that might otherwise seem random or frightening. The ripple effects of this gold and silver slump extend far beyond the metals themselves. When precious metals move sharply, they often reveal something deeper about how investors feel regarding the broader economy, inflation, and government debt. Understanding these consequences helps explain why so many people, from retirees to institutional fund managers, watch these markets so closely. One of the clearest signals comes from the connection between precious metals and economic confidence. Historically, when investors grow uncertain about currency stability or long-term government debt levels, they turn toward gold and silver as a form of protection. This is why many analysts describe gold as a barometer of financial trust. When that trust wavers, even temporarily due to rising interest rates or a stronger dollar, prices can swing quickly in either direction. The current pullback reflects short-term pressure from rising rates, not necessarily a change in the long-term reasons people continue holding precious metals as protection. Platinum and palladium are also feeling these effects, though the story here is slightly different. Both metals are tied closely to industrial demand, particularly in manufacturing and automotive industries. Analysts have identified specific support zones where buying interest could return, suggesting that some investors view current price levels as an opportunity rather than a warning sign. This creates a mixed picture across the metals complex, where some assets are viewed as oversold opportunities, while others may still have further to fall. Copper offers perhaps the most important economic signal of all. Unlike gold and silver, copper is deeply connected to real-world industrial activity. It is used extensively in construction, electronics, and energy infrastructure, which is why many analysts refer to it as a measure of overall economic health. Just weeks ago, copper prices were surging, with widespread expectations of a major breakout driven by growing demand from data centers and technology infrastructure. Instead, prices were rejected at a key resistance level and have since begun forming a bearish pattern. This shift in copper is significant. If copper continues declining over the coming months, some analysts believe it could reflect early signs of a broader economic slowdown. A pullback in data center construction, softer capital spending by major companies, or a general cooling in economic activity could all contribute to weaker copper demand. Since copper often moves ahead of major economic shifts, its recent weakness deserves attention beyond just commodity traders. For everyday people, these consequences may feel distant at first glance, but they connect to daily life in meaningful ways. Interest rate changes affect mortgage rates, savings account returns, and borrowing costs for small businesses. Currency strength influences the price of imported goods. And metal prices, particularly industrial metals like copper, can signal future employment trends in manufacturing-heavy communities. These are not isolated financial stories. They are threads connected to household budgets, retirement accounts, and regional economies. It's important to recognize that experts remain divided on how these events will unfold. Some analysts view the current downturn as a healthy, expected correction within a much larger, multi-year uptrend for precious metals. Others urge more caution, pointing to the historical severity of past drawdowns and reminding investors that markets rarely move in a straight line, in either direction. Both perspectives rely on the same historical data, yet arrive at different conclusions about timing and depth. This is a reminder that even experienced professionals interpret market signals differently, and no single voice holds all the answers. What remains clear is that gold, silver, platinum, palladium, and copper are all sending interconnected signals right now. Together, they paint a picture of an economy adjusting to shifting interest rates, geopolitical uncertainty, and evolving expectations about long-term growth. Gold and Crest Finance will continue monitoring these developments closely, helping viewers separate short-term noise from the more meaningful economic trends unfolding beneath the surface. As this story continues to unfold, many viewers may be asking themselves an important question. Is now the time to pay closer attention to precious metals, or is it wiser to simply wait and watch from the sidelines? There is no single correct answer, and that is exactly why ongoing awareness matters so much. Markets rarely move in straight lines, and understanding the forces behind these price swings can help viewers make more informed decisions, whatever those decisions may be. Looking ahead, analysts studying long-term cycles suggest the current downturn may not be finished just yet. Based on historical patterns stretching back to the 1980s, some strategists believe gold could still test lower levels before this particular cycle reaches its true bottom. If history continues to rhyme the way it has in previous decades, a bottom near the $3,500 range remains a possibility many analysts are watching closely in the months ahead. What makes this story even more compelling is the longer-term projection tied to these cycles. Analysts point out that previous bear markets in gold lasted very different lengths of time. The decline following the 1980 peak stretched on for roughly 3 decades, while the more recent cycle following the 2011 high lasted around 15 years. Because each cycle has historically been shorter than the one before it, some strategists believe the next full cycle could take as little as 5 years to reach its peak. If that pattern holds, and if current projections prove accurate, some analysts estimate gold could potentially approach the $13,000 level by the early 2030s, somewhere in the range of 2031 to 2033. It is important to state clearly that this projection is not a guarantee. It is based on historical cycle analysis, not a certainty about future prices. Markets are influenced by countless factors, including government policy, global conflicts, technological change, and shifts in investor psychology that cannot always be predicted in advance. Viewers should treat these projections as one piece of a much larger puzzle, not as financial advice or a promise of what will happen. So, what should viewers do with this information right now? Financial professionals generally recommend staying informed rather than reacting emotionally to short-term price swings. Understanding the difference between daily market noise and long-term historical patterns can help reduce fear during volatile periods like this one. For those interested in precious metals, following credible market analysis, understanding historical cycles, and consulting a licensed financial advisor before making investment decisions remain the most responsible paths forward. This moment in the gold and silver market is more than just a single day of red numbers on a screen. It reflects a much larger story about global tensions, government debt, currency strength, and decades of repeating human behavior in financial markets. Whether someone is a longtime investor or simply curious about what these headlines mean, this story offers a valuable lesson in patience and perspective. Before signing off, here are a few questions worth considering. Do current price patterns remind viewers of previous market cycles they have lived through themselves? Does a projection stretching all the way to 2031 feel meaningful or too distant to plan around today? Viewers are encouraged to share their thoughts and experiences in the comments below, as these conversations often provide a valuable perspective for others watching as well. Gold and Crest Finance will continue tracking these developments as they unfold, bringing clear, balanced analysis without unnecessary noise or speculation. Markets will always rise and fall, but understanding the story behind the numbers is what truly empowers thoughtful decision-making. Thank you for spending this time with Gold and Crest Finance. Stay informed, stay patient, and stay ready for whatever these markets bring next.